Well, hello and welcome to Dean Dorton's webinar today on year-end tax planning and accounting reminders for equine operations. I'm Jen Shaw and I lead our firm's equine practice. For those of you who are not yet familiar with Dean Dorton, our firm has the privilege of working with over 1,000 equine clients across the U.S. and around the globe, assisting with U.S. tax matters, accounting, bill pay and budgeting, technology support, data analytics work, and risk assessments, to name a few. I am joined today by my colleagues, Emily Anderson and Melissa Hicks, who will cover these timely topics regarding accounting and tax. The focus of today's webinar is equine ventures operating as businesses or for-profit ventures. Today's webinar qualifies for 1 hour of CPE for those licensed CPAs attending. To receive the CPE, you will need to answer all of the polling questions throughout the session. I will put up polling instructions shortly, so you may get registered. Early next week, you will receive a form via email to claim this CPE, along with a link of today's recording and the related slides. We'll then issue the CPE certificates by December 31st. A brief reminder before we get started. The items that we discussed today provide general information only and may not address your specific tax or accounting situation. So we ask that you please consult your financial and tax advisors, either here at Dean Dorton or elsewhere, prior to acting based on our general discussion. With that, let's get into our objectives for today's webinar. We'll first focus on some Form 1099 reporting reminders, then cover federal tax incentives and tax limitations to be aware of, and then we'll finish with some year-end tax planning items. The next slide's important as it addresses how to register and respond to those polling questions for those of you who are getting CPE. You may register via either text or internet, and I'll give us a few seconds to get this set up. While you're setting this up, I want to let you know that there is a Q&A function where questions may be submitted. We will monitor questions as they are received, and we will do our best to address either during or at the end of the webinar. All right, hopefully everyone's been able to register for the polls. So now I'm going to turn it over to Emily, who will first walk us through the Form 1099 reporting reminders.
Awesome. Well, thank you so much, Jen. Good morning or good afternoon, everybody. My name is Emily Anderson. I am a manager in our accounting and financial outsourcing department, specializing in the equine industry. So I want to take the next 15 minutes or so to go over some 1099 reminders along with some year-end reminders for the 1099 reporting. So, just a quick funny to start us off. Has anyone else felt like this in January or feel like they are going to feel like this in January? Well, our goal today is to make sure that you feel more prepared going into this year-end season, and making sure that you feel more prepared than when you perhaps started this webinar. All right. So we have our first polling question for the day. So I want to take a moment to understand what your goal or what you're hoping to get out of this session today. So I know a lot of us are hoping to get all of our CPE in by the end of the year. I hope some of us are here for the 1099 reporting, or perhaps some of us are just here for the tax updates. So I hope everybody was able to get registered with the polling question. So I think we can go ahead and see if we have any responses so far. All right. Well, good for those of us who are trying to get our CPE. As Jen mentioned, we are trying to get these CPE certificates issued to you by the end of the year. So for those of us who are trying to get in by the end of the year, don't worry, we've got you covered. Right, so most of us are here for the tax updates. I completely understand, but we'll go into what we're talking about today with the 1099s in just a second. All right. All right. So one of the things I recently learned is adult learners want to have an understanding of why they're learning something. So first, We're going to talk about why we're talking about 1099. So why are we here? Then we're going to go into definitions relating to the 1099 miscellaneous and 1099 NEC. And then we're going to talk about the different examples between the 1099 miscellaneous and the 1099 NEC. So we're only talking about these two forms today because they're the most common forms that we see in the equine industry. There are, of course, multiple different 1099 forms, but for today and our purposes, we're just going to talk about these two. Finally, at the end of our 15 minutes on 1099s, we're just going to go over some reporting deadlines. And I'm also going to bring up a topic or an example of some other changes with another 1099 form that we may also end up seeing this year. So to start us off, why do we care about 1099s? Well, of course, the obvious is they are required by the IRS. But another thing we want to think about is making our life easier for the recipients. Um, We obviously want to file all of our items correctly, and our recipients or our vendors are no different. So when we issue a 1099 to our recipients, it helps them reconcile their income back to their records. So it's being helpful to our recipients. We don't want to think about being helpful. We definitely want to think about avoiding penalties and IRS notices. That can definitely ruin your day. So you can be penalized if you fail to file by the deadline or even file with incorrect information. The penalties can vary by business size and can be up to $660 per return with no limited or maximum penalties for intentional disregard. So I want to make that point because if you fail to file with intentional disregard, those penalties can be steep. So I want to make sure everyone's still with me. So if you can react at the top of your screen, that smiley face button, can you give me a thumbs up to make sure you're still tracking with me? Awesome. Thank you, everyone. So now we're going to jump into some of our definitions. And quick note, the NEC and the miscellaneous, there's not going to be very much differences in terms of when you file, but we're just going to cover some of the basic requirements just as a reminder. So we're going to start off with the 1099 NEC, which stands for non-employee compensation. This is a form that was introduced in the last couple of years, so it's still maybe a little bit unfamiliar. So you're going to issue a 1099 NEC if you make a payment to someone who is not your employee. So this is going to be a contractor, somebody who's working on the farm, somebody who's providing you boarding services, things like that. So additionally, you're going to want to make sure that you're sending a 1099 NEC for making payments in the course of your trade or business. This is not going to be something where sending a 1099 NEC is not going to be issued when you're issuing a payment as an individual. This is again just in the course of your trade or business. Additionally, you're going to want to send a 1099 NEC when you made a payment to an individual, a partnership, an estate, and in some cases, a C corporation. You will find this information by by receiving or asking for a W-9. I want to point out that the W-9 was revised in March of 2024. So it is best practice to request W-9s or new updated W-9s from your vendors yearly, or at the very least, when a new W-9 form has been issued. Lastly, I want to highlight that payments of at least $600 are required to be reported. So you may have a vendor. We had this instance just recently in our team where we had a payment to a vendor of $599.99. Maybe the vendor was being a bit sneaky, but you're not required to send a 1099 if the payment is under $600. Now, this is going to include multiple payments. So if you have four payments to a vendor during the year and they still don't equal that $600, you still do not need to report on the 1099 NEC. One thing I want to point out for some cases of a C Corp is you will need to issue a 1099 NEC for legal services, even if on the W-9 the law firm is showing that they're a C Corp or an S Corp. So I just want to point that out. You still are required to send that 1099 NEC, even if they are a C Corp or an S Corp, for just legal services. So moving on to the 1099 miscellaneous, same things. The personal payments are not reportable. You're going to report 1099 miscellaneous for the payments made in the course of your trade or business. You made the payment to an individual, partnership, estate, and in some cases, a C Corp or an S Corp. And In this case, for the 1099 miscellaneous, the S Corp or the C Corp are going to be medical payments. Now, that is the terminology used on the IRS instructions. So for the equine interpretation, the medical payments are going to be for a licensed veterinarian. And we'll go into some of the details on that in a second. So I want to just point that out. One other thing to point out for the cases of a C Corp or an S Corp, gross proceeds, or AKA a settlement agreement, paid to an attorney or a law firm are also reportable on box 10. We don't typically see that a lot, but just in case you come across it, that is going to be the instance where you are going to still report on the 1099 miscellaneous. And again, just like the NEC, you're going to report if you make a payment of at least $600 during the year. All right. So now we know when we need to report. Let's talk about how we report. So first up, we have the 1099 NEC. So thankfully, the NEC only has a couple of boxes, and we're going to talk about box one, which is going to be the most commonly used box when you're filling out a 1099 NEC form. So you're going to include uh, services such as training, boarding, vanning, farrier, contract labor, consulting, accounting services, lawn services, legal attorney fees, chiropractic, podiatry, equine spa, electrotherapy, dentistry. I mean, the list can go on and on. But again, we're talking about services and not products. So in the small print there, I want to mention that on those training or boarding statements, you're going to include all items included on that statement. So even if it has medical payments, farrier supplies, miscellaneous things, you're just include all of that on that payment to that boarding facility. So one item I do want to point out is you're not going to include stud fee payments or horse purchases on a 1099 NEC. We're not going to get into the nitty gritty, but we've taken the stance that stud fee payments are not a service, but rather you're getting a product at the end of it. So that's why we will not include stud fee payments as part of the 1099 NEC. Again, I also want to point out that legal and attorney fees will be included on the 1099 NEC, even if they are a C Corp or incorporated. Accounting services are not part of the requirements for an incorporated business, and Dean Dorton is a professional corporation, so please do not send us a 1099 NEC for our accounting services. Please and thank you. I do want to point out again on the NEC, and we'll get into this in a second, is some of these chiropractic, podiatry, equine spa, electrotherapy, dentistry, you might consider those medical payments. However, most of the time we see these people are just going out and doing it. They're not an actual licensed veterinarian. So these types of services, if they are being done by Joe Smith down the road, who just happened to, go to some type of training for podiatry or equine spa. Podiatry, you're probably more likely going to be a vet. We see that a lot. But any type of chiropractic work, and it's done by somebody who's not a veterinarian, is going to be recorded on the 1099 NEC. All right. So now we're going to get into the miscellaneous, which of course is miscellaneous. It's going to be a catch-all for a lot of different types of payments. So in box one, you're going to put rent office space. So we would not consider board, even though it sounds like renting, it's not going to be included in the miscellaneous box one. So rent office space and equipment rentals. I do want to point out that rent paid to a real estate agent or a property managers are not 1099 reportable. However, it's sometimes difficult to understand if they are a property manager, if they are a real estate agent. So we have a saying in AFO, we like to say, when in doubt, send it out. Those real estate agents and property managers will let you know if they are one of those, and they may ask you to void or otherwise take that off their 1099 miscellaneous, but otherwise, when in doubt, send it out. So box three is going to be prizes and awards, not including payments paid to your employees. Those are going to be reported on Form W-2. Box three is going to be payments made to your racing partners. So we see this a lot where we are the managing partner. We've received 100% of the proceeds, but we're not the 100% owner. We're going to pay that out to Joe Smith, his 50%. We're also going to send him a 1099 miscellaneous box three for his 50% proceeds that we've paid out. And then last but not least, box 6 is going to be for veterinary entity payments. And this is going to be for all vets, even if they're incorporated. So again, we want to make sure that we're including a payment to a vendor on box 6 for 1090 miscellaneous. They are a medical professional. So you'll see either a DVM, which is the most popular, or you may also see a VMD, which is a licensed veterinarian, but they're from the University of Pennsylvania. So VMD or DVM. All right. So to wrap us up in our topic today, we're going to talk about some other reminders just to keep in mind as you go through the end of the year and in January. So there are different filing dates for the miscellaneous and the NEC. You can see those here, but just to be safe, you're going to want to try and get all of your 1099 forms done by January 31st, 2025. And it's also nice to get them done and over with so you can worry about other things like taxes for the rest of the spring of 2025. Form 1096 must accompany both 1099 miscellaneous and 1099 NEC as a cover for IRS submission. Um, and I know I didn't specifically mention it, but do not include any reimbursements on any miscellaneous or NEC. This is going to be just for uh, contract labor, services, things like that. So not in any reimbursements. Finally, for an EIN, for a single member LLC, you can use the recipient's personal name and DBA business name, doing business as business name, with a social security number. For partner LLCs, S Corps, and C Corps, you must use an EIN provided by the IRS. So if you get a W-9 back and they've marked that they're an LLC partnership and they've put in a social security number format, you're going to want to go back to that vendor and tell them to basically refill it out because they've filled it out wrong. So last but not least, I want to talk about a 1099K update. So there's a new threshold for 2024, it's $5,000. So in prior years, prior to 2024, there was so 1099K is payments made to Venmo, Square, basically third-party payments. In prior years, the threshold was $20,000 in gross payments and at least 200 transactions. So you can see in 2024, this has been severely reduced. So in 2024, these online third-party platforms must report payments totaling $5,000 or more in a calendar year with no transaction minimum. So keep this in mind. You may receive one of these from a third-party vendor such as Venmo or Square, or your vendors who you are paying via Venmo or Square may get one of these from those third-party vendors. So again, just keep that in mind for 2024. With that, I want to see if there are any questions. All right. Well, thank you all for your time today. I do appreciate it. And if there are any questions that come up, please feel free to reach out to me directly. I'm happy to help.
Thank you, Emily, very much. My name is Melissa Hicks. I'm a tax director here at Dean Dorton. I, with Jen Shaw, help lead our equine tax practice. It's something that we've been doing for over 22 years together. And we always love the opportunity to get in front of all of you and talk about what's new and great in the equine world of taxes. So I'm going to walk us through a few reminders and really start with federal tax incentives. One of the primary questions that we get frequently is how much of a horse can I deduct if I acquire a horse? So we'll walk through some depreciation reminders, nothing really new on the horizon, but one of the tax incentives that we see frequently used is bonus depreciation. And bonus depreciation allows you to write off in the first year a substantial amount of the acquisition cost of a qualifying asset. Prior to last year, that deduction was 100% of the cost. It is now in the process of phasing down. Last year in 2023, we had an 80% write-off. In 2024, we're at a 60%. So let's take, if you bought a horse for $100,000, you could only write off 60,000 of that horse under bonus depreciation in the first year, but the additional $40,000 will qualify for depreciation expense deductions, and that amount will depend on the type of horse. Phasing down through 2025 is 40%, and then in 2026 it's set to phase down to 20%. Jen will talk a little bit about sunsetting provisions later, but we know that bonus depreciation is something that we would like to see reestablished back to 100%, or at least be permanently established at some level. In order to qualify for depreciation, and bonus depreciation, the property must be placed in service. And placed in service is different for different types of horses. Racing prospects, generally when that horse begins training in the fall of their yearling year, or when they begin racing their first race, maybe in their 2-year-old year, they would qualify as placed in service. Sport horses, when a horse begins training or when they begin competing, will qualify, and breeding stock when they're available to be bred. And just using the thoroughbred industry as an example, the Keeneland broodmare sale in November, you can buy a broodmare and place it in service, even though we know that the horse under thoroughbred industry will not start actually breeding until the next January, February timeframe. But because it's available for use and could be bred, it would qualify as being placed in service. Most horse purchases will qualify for bonus depreciation, but there are certain limitations. If you own the horse previously, you cannot rebuy it and place that and claim bonus depreciation on that new purchase. We actually see this quite frequently happen, where you've maybe bred the horse, then sold it, then turn around and bought it as a breeding horse later on. Horses used predominantly outside of the U.S. don't qualify for bonus depreciation. If you buy a horse from a related party or receive it via inheritance or gift, that also doesn't qualify. Horses that just generally don't qualify for depreciation won't qualify for bonus depreciation. And horses that don't qualify for depreciation are horses that you're pinhooking, which is inventory, horses that are not placed in service. Think of weanlings. Weanlings are not being placed in service in the course of the business yet. They won't until at least their yearling year. So those would not qualify for bonus depreciation until you actually place them in service. Other common equine assets that might qualify: equipment, computer equipment, farm equipment, fencing, land improvements, barns. Barns are actually 20-year depreciable life, and bonus depreciation, one of the criteria is that it has to be a 20-year life or less to qualify. So barns would qualify for bonus depreciation. We're finding that bonus depreciation is very helpful on farm purchases, and because bonus depreciation is not at 100% anymore, we're finding that if you go out and acquire a farm, it's beneficial to potentially get a cost segregation study. And a cost segregation study allows you to break out that land and property purchase into lower or into categories where you can depreciate and accelerate the depreciation faster. The next expensing option under tax law is Section 179 expensing. This is something that we don't use often, but I've seen over the past year as bonus depreciation is phasing down. opportunities to utilize Section 179 expensing outside rather than using bonus depreciation. And I'll talk a little bit about why that is. But Section 179 is like bonus depreciation. It allows you to expense 100% of the cost of an asset if it qualifies, and up to an annual limit of 1.2 million, a little over 1.2 million during 2024. Now, if you have qualifying purchases, there is a threshold. That limit phases down if your qualifying purchases exceed a little over $3 million. So there are additional limitations for Section 179 expensing that you would not see for bonus depreciation. One of those is Section 179 cannot create a tax loss. You can only utilize that if after you take Section 179, you either have zero net income or you continue to have net income. That's different than bonus depreciation. Bonus depreciation, you can create a tax loss with. And the reason we don't see Section 179 as often is because we generally are creating losses with our bonus depreciation. It also is only available to be used on active trader businesses, and active is capitalized because we'll talk about in a minute a little bit a difference between active and passive. So you have to be active in a trader business to be able to claim that. Depreciation, who makes the decision? So if you own a horse via partnership, the depreciation decisions are made by the partnership and are passed through to the partners on their Schedule K1. If you own a horse via joint co-ownership, each individual co-owner makes the decision on how they want to depreciate that asset. So if you can choose to either claim bonus depreciation if you qualify, and it makes sense to take Section 179, you can make that choice individually. A partnership, it's done at the partnership level. One thing to note, these depreciation incentives are great. Most states some states will follow federal, but a lot of states do not follow federal. So you may have an accelerated deduction for federal purposes, but for individual states, you may not be able to recognize that. Another federal tax incentive that came into effect with the Tax Cuts and Jobs Act was qualified business deduction. The qualified business deduction is a deduction that is only available to non-C Corp taxpayers, and it was put in place to get non-C corporation businesses kind of in line on the tax rate as C corporations have. C corporations have a 21% tax rate, so this was a mechanism to kind of pass through some tax savings to non-C corporation taxpayers. It's calculated at the individual owner, partner, or S corporation shareholder level. K1s will provide information for each member to include this and calculate the deduction on their personal tax return. So a lot of times, if you have more than one business and more than one activity flowing through, this is calculated, and considerations for all of those activities are having to be calculated down at your individual level. The deduction is generally 20% of the qualified business income from all businesses, with limitations in certain cases. It cannot exceed 20% of taxable income, and you have to exclude your capital gains when you're making that calculation. I will say that I spent a lot of time on the QBI deduction when it first came out, and it is an area that you constantly run into limitation after limitation. So it's important to understand all of that so that you know and can plan for how this tax incentive can ultimately benefit you as a taxpayer. Let's walk through a basic calculation of the 20% qualified business deduction. If you have an individual filing a joint return and has taxable income of $250,000, that taxable income does not include any capital gains. So we're walking through a very simplistic example. Your boarding and breeding business generates $300,000 of ordinary net income. The deduction that you would get under QBI in this example is the lesser of 20% of taxable income, which is $50,000, or 20% of the qualified business income. And so that boarding and breeding business, the QBI in that is $60,000. So your deduction is going to be limited to $50,000 versus the $60,000. Another example, you have the same taxable income as the prior, $300,000 of that of net income from boarding and breeding, but your horse racing activity generated a net loss of $200,000. To claim the deduction, you actually have to combine the deductions at the for each of the activities. So the deduction is the lesser of 20% of taxable income, which is $50,000, or 20% of the qualified business income calculated for each business. So the qualified business income deduction for the boarding and breeding is $60,000. You subtract out the qualified business deduction for the racing activity, so it gets you to a net deduction of $20,000. So the deduction is $20,000. There are one tax planning item. If you have a business that pays guaranteed payments to the partners in a partnership, guaranteed payments don't qualify for the QBI deduction. So is there a way that we can actually rework the partnership agreement to replace guaranteed payments and work on allocating income through special allocations? The special allocation has the potential to increase the QBI income deduction for those partners that were previously receiving guaranteed payments. So if you have that situation where you're receiving a guaranteed payment from them, then you can deduct that, or you can look at that and see if there is an opportunity to restructure it. I'm going to kind of work through this a little bit quicker. Limitations may apply if 2024 taxable income exceeds the threshold. You do phase out of your deduction if you're single at 191,000, or begin phasing out, and that married filing jointly 383,000. So there's possibility that you will not qualify if your income exceeds certain phase out thresholds. Some other federal tax reminders I wanted to go through. Generating the excess business loss is still in place. The Tax Cuts and Jobs Act limited business losses deductible by non-corporate taxpayers against non-business income. So essentially, if you have net tax losses from businesses in excess of $250,000 for individuals and $500,000 for joint filers, that's the adjusted, and that those numbers are adjusted for inflation. Those losses are can be suspended until the next year. For 2024, those amounts are $305,000 for individuals and $610,000. You don't lose those losses; you just can't take those this first year. They will roll over and be net operating losses in the year thereafter. This expires on 12/31/2028. And then our favorite topic right now, especially in December, I'm not going to spend a lot of time on this, but is the Corporate Transparency Act. It requires certain entities to file beneficial ownership information. There is a court injunction out there now that is that could potentially say that that you don't have a filing requirement. I would tell you that you need to check with your attorney and your specific situation, because it does matter. It's a potential of, we don't know whether or not this injunction is going to keep when it goes to appeals or not. So whether or not it makes sense for your company to go ahead and do the filing, just to make sure that you're not getting hit with penalties for non-filing. We do have a polling question. How many horses do you or your employer own? If you guys can start answering that, that'd be great. All right, we're getting great responses. I'm going to go ahead. It's looking like we have 1 to 5 and then over 50. So we've got an interesting mix of folks here. Okay, we're still getting answers. All right, looks like I think everybody's got their responses in. Great. Okay. Well, I'm going to move on and let Jen Shaw kind of pick up and talk to you about hobby loss and passive activity reminders.
Great. Thanks so much, Melissa. And I wanted to briefly cover these next 2 tax topics today because I spend so much of my time handling IRS controversy work. And most of the audits that I deal with cover these 2 topics. So I'm going to cover at a high level, and then we'll go into some of the expiring provisions as well. So in addition, most IRS agents are unfamiliar with the equine industry and often make incorrect assumptions about motives and horse operations in general. So I first want to talk about the hobby loss reminders. The hobby loss rules are applicable to individuals, estates, trusts, and the related pass-through entities like single-member LLCs, partnerships, and S corporations. So they're not specifically applicable to corporations, because corporations don't flow through their net activity to shareholders. So through calendar year 2025, expenses with a hobby are no longer deductible. So it's kind of a heads I win, tails you lose scenario for the government. If you're deemed a hobby operation, then you've got to pick up all of the revenue and get none of the expense offset, even up to the related revenue. So it obviously is a big deal to be deemed a hobby operation versus a business. And essentially, if you're deemed a hobby, you permanently lose the tax deduction for those related expenses. And we see with accelerated depreciation, Melissa talked about bonus depreciation. We've had 100% and 80%, now 60% in 2024. Obviously, we have you are accelerating your tax deductions, and then furthermore, in the horse industry, most owners qualify for cash basis accounting. So if you are, you have basically the deduction that you're paying ahead of the income opportunities. So stud fees are deductible when paid, so you can you pick those up when they're paid, and then but the related income opportunity might be up to 2 or 3 years down the road after that. So so that's why a lot of these are getting pulled for audits, and we're seeing it quite a bit again across the country, and that's really where I spend the bulk of my time these days are defending horse and farm owners on this particular item. And so from a hobby loss perspective, the IRS lists 9 factors for determining whether or not an activity is conducted with the intent to make a profit. And that's what they're looking at. When they're looking at the hobby loss rules, it's what are you doing to make a profit? And, focuses on how the operation is run, the advisors that are used, the history of income and losses, and basically the dependency on this activity when you're looking at what the regulations, those 9 regulations. There's no single factor that's determinative. But what we found in our practice is that really looking at case law, are, the most important are good quality books and records, and the development, adjustment, and or evaluation and adjustment of items that are working or items that are not working in order to achieve a profit. So that's what we've really seen, especially over the past few years. There is a presumption out there that's available for those in the equine space that's generating a tax profit in 2 out of 7 years. And so that's just it's a general presumption. And essentially, if my horse operations or my equine operations generate a profit in 2 out of 7 years, then I am presumed to be, my horse operations are presumed to be a business versus a hobby. So what that does, it just shifts the burden of proof. So if I have a profit in 2 out of 7 years, then the IRS has the burden to prove that I'm a hobby versus a business if I get audited. There is no reverse presumption. So many horse owners, it's hard to meet that 2 out of 7 rule. And so what that means is that we just have the burden to prove that you're operating as a business versus a hobby. And so I will mention that the IRS has formed a new pass-through entity audit division, and that was announced last fall. It is up and operational. They've announced it just last month. They've confirmed it. We've seen some of those audits, and they're really focusing on pass-through entities. So it's not equine specific, but a lot of the equine operations are run through pass-through entities. So we, will likely see equine operations be audited by this new pass-through entity unit within the IRS. So from a best practices perspective, maintain quality financials, annually evaluate what is working. And when I mean what is working, I mean also financially. So oftentimes horse owners measure success based on results from races or shows or things like that, but it needs to have a financial component to it as well. And hopefully it does. If you're successful at the track, hopefully that converts into greater purses or better sales opportunities at the tail end of a racing career. And if there's a particular idea or program that's not working or has not been successful, evaluate what you can do to try to set yourself up for better success in the future, or how you're going to change it to put yourself in a better position to potentially create a profit. And then consider tracking activity by horse. I know that can be tedious for those of you that have, there's a lot of people that said over 50 horses. We use accounting software to do that for us. It's very helpful. We've done custom reports so we can track for our breeding clients ROI by mare over, over multiple generations to show that maybe even if the whole enterprise has not been profitable, at least we've made profit on a per horse basis, or certain specific horses have been profitable. So again, we just wanted to cover at a high level today to remind you, just because we're seeing so much of this hobby loss rules that are being addressed in these audits and this IRS controversy work. But again, it's a good time to just get your ducks in a row as sales season's over from a thoroughbred perspective, and so or ending. So look at what what's working, what's not working as you're looking at forward into upcoming calendar year 2025, and how how you might improve financial operations if that's a possibility. The next topic I want to talk about really briefly is the active versus passive, the passive activity rules. So this is a separate topic. A lot of times these are combined by, I hear people say, oh, well, if I spend 500 hours, I'm a business. Well, the 500-hour rule is technically the passive activity rules. And so the passive activity rules are not as detrimental as the hobby loss rules. Hobby loss rules, you sort of lose the ability permanently to deduct those expenses. The passive activity rules just may currently limit the deductibility of the business losses, but you don't lose them. So it's not fatal like the hobby loss rules. But again, in order to be considered an active participant, most people in the horse business utilize what's called the 500-hour rule. So they spend at least 500 hours of qualifying time. And there's not, there's not any clear rules as to what counts, but some of the qualifying time would be attending sales, attending the competitions at the track or at the showgrounds, the time leading up for, pedigree research if you're selling or buying, obviously time spent caring for the animals that should count. There is one caveat that we need to be, that I would caution people on. Investor hours for this purpose don't count. And that's if I am an owner of a business and I'm reviewing a financial statement that someone else has put together for me, and I'm sort of just looking it over, and really more evaluating it from as an investor, like I would evaluate whether or not I buy a specific stock or not. Those hours technically don't count, but the hours that you spend making decisions and making, doing the work, paying the bills, those obviously do count. So there's just a little distinction there that I wanted to point out from a counting hours perspective. And I will say that the activities of spouses are combined. So, so sometimes it's a nice opportunity to take your spouse to the racetrack. So with that, we're going to move on briefly just to talk about some expiring Tax Cuts and Jobs Act provisions and just a little bit of commentary about the election. House Republicans, so as we all know, we've got Republicans that have, won obviously, President Trump, President-elect Trump is Republican, House and Senate controlled by Republicans. And so, everyone's monitoring as to what this means going forward. During 2024, we've had some draft tax bills that have included things like increasing bonus depreciation back to the 100%. And, improvements to some interest expense limitations, which would be helpful. I mean, those are the two big ones for the equine industry. So what we'll see if future legislation includes what some of the draft legislation that was issued but not passed in 2023 included. So, House Republicans have prioritized a tax bill during the first 100 days, according to their statements. Yesterday or earlier this week, Senate Republicans said that a tax bill could come later in a separate package during 2025. And, some say that may be trying to manage expectations. So I think we'll continue to monitor. Likely, obviously, Q1 2025 would be the earliest that we might see something. But and that would probably be preferable, so we could actually make some decisions based on actual tax law, not what we think might happen. But a lot of it is up in the air right now, and it's a little bit different landscape than what we had back in 2017 when the Tax Cuts and Jobs Act was passed. So in addition to just kind of giving some thoughts on what may happen, we wanted to go through for reference what we know will go away under current law. And so without congressional action, some of the provisions that will sunset beginning or after December 31st, 2025. And so you see on your screen there a listing of these key provisions that are expiring. So, the individual income tax rate going from 37 up to 39.6%. The two items I'll point out here are the suspension of miscellaneous itemized deduction. That if you're a hobby operation, you did used to be able to claim as a miscellaneous itemized deduction the amount of expenses up to income generated. So that has gone away through 2025, and it's scheduled to come back after 2025 under current law. That was mitigated by a lot of people being an AMT, and that gets added back for AMT. So it really ended up being a non-issue and no tax benefit anyway. And then the one that's that everyone talks about is the cap on state and local taxes, and we've seen a significant shift into doing a lot of pass-through entity taxes to put that in as an ordinary business expense to get around that $10,000 cap. But those are probably the two that are most applicable. Obviously, we talked about bonus depreciation, the phase down, and then another big one for horse and farm owners in particular is the expiring estate and gift tax provision. So basically, after December 31st of 2025, there's inflation adjusted amounts. The inflation adjusted amount we currently have it's 10 million, but during 2024 it's 13.61 million per person, and 2025 is scheduled to be 13.99 million per person. If nothing else is done, it will decrease back to an inflation adjusted 5 million after or beginning in 2026, which is probably estimated to be around 7 million. So big difference from what you can give away now versus what is scheduled to be out there. But again, in general, it's looked upon favorably, the election results and potentially being able to get that increase going forward. But this is what we have to deal with right now. So with that being said, I'm going to turn it over to Melissa, who's going to talk to you about some year-end tax planning that can be done.
Yeah, thank you, Jen. Yeah, just spend the last little bit talking about a few year-end tax planning reminders, and then we'll have some Q&A time. So please, if you have any questions, please put those in the Q&A chat, and we will address those, or address those after if we run out of time. So, all right. So right now we're in December. We're close to the year end for most taxpayers who are on a calendar year. If you haven't already talked to your advisors, it's good to go ahead and start tracking down your year-to-date results to see if you do need to do any tax planning. We still have almost a month, so there are things that we can do. Emily would tell you need to go ahead and start gathering your W-9s from vendors so that come January, you're not trying to scramble to get those, and you can get those 1099s out early and have a better January. A few things to consider. Normally in tax planning, we're looking at how can we reduce our taxable income. In some situations, it's better to increase taxable income. So you could consider electing out of bonus depreciation. And why would you do that? Well, if you know in your next year you're going to need some deductions to offset in the next few years, then you might want to save those deductions for later, because we know depreciation is a timing matter, and you can do that on an asset by asset, a class by class basis. Reducing taxable income. Most equine industry participants use cash basis reporting. So to do that, as long as you have a non-tax reason for prepaying expenses. For example, if you get a discount for prepaying a stud fee, it may make sense to go ahead and pay that now so that you can take the deduction now because you're on a cash basis. Or if you, so most times we see that you're getting a discount or access to a particular horse to be able to pay those things. Installment sales treatment is another opportunity. If you have, if you're selling a horse and especially in a private transaction, and you have an opportunity to receive some of those sales proceeds in the next calendar year, you can elect to use installment sale to defer some of that gain. Now, be aware, if you depreciated that horse, you do have to recapture and pay tax on the full depreciation recapture that you've taken in the year of sale, not in the year you receive the proceeds. Another opportunity is an involuntary conversion that's not on here. If you've had a horse that has passed away, and then you received insurance proceeds and have a gain, you could potentially defer that gain by reinvesting those insurance proceeds in like property. And you have up to 2 years to do that. Donation of a horse. We have this question come up quite frequently. This is a very complicated area. I would tell you that if you have this and want to do it, you talk to your advisor, as this is something that you could potentially you need to plan around to make sure you have all of the proper documentation and are maximizing your deduction. It does require a qualified appraisal of the horse. There are lots of limitations. Generally, you get the fair market value of the donated horse, but it must be reduced by the amount of gain on sale that would be ordinary income if the horse were sold at fair value. So there are possibilities that if you give away a horse, the fair market value may be $100,000, but your actual charitable deduction could be zero, depending on your facts and circumstances. And another limitation that we always consider is whether or not that horse you're giving, is is it going to be used for the charitable purpose of the organization, or are they going to sell it? That would limit the deduction. And there might be other alternatives, like selling the horse to the charity and then or selling it to a third party and giving the proceeds of the sale of that horse to the charity directly. So just be cautious of donating horses and working with your advisor to make sure that you're maximizing your deductions. All right, so if you have any questions, please type those in the Q&A section. We have about 5 minutes, so we'd love for some interaction if you have any.
And I will also say, Melissa, that if you go to the next slide, it has all of our contact information on it. So if you do have some questions and you'd prefer to reach out to us directly, feel free to reach out to one of us, and we'll make sure we get back to you. You will, as I mentioned earlier, receive a copy of the slides and the recorded presentation today when you via email next week when you get the form to complete for CPE. All right, I'm not seeing any questions come through, so I think we appreciate everyone's attendance today, and we'll look for that email next week. And please feel free to reach out to any of us with any of your tax or accounting questions. So thanks, everyone. Have a great day.